Have you ever wondered how to make a fortune when the whole world is crying over a market crash? Most of us are taught that to make a profit, you have to buy low and sell high. But there is a group of people who go completely against that rule. They sell first, buy later, and the deeper the market plunges, the more their pockets swell. That is the risk-filled yet incredibly thrilling world of short selling. Is this a genius tactic or just a gamble based on the suffering of others? And why are massive investment funds willing to bet billions of dollars on the collapse of an economy? Is short selling the vulture of the market, or is it the doctor diagnosing asset bubbles about to burst? Watch this video to the end to decode the entire mechanism, the risks, and the shocking truths behind historic short selling trades, and don't forget to like the video and subscribe to the Ngui Key Fact channel so we can continue creating more meaningful content. The majority of people, when entering the market, have only one mindset: wait for the price to rise, buy in, and then sell to enjoy the margin. This logic is so simple that even an elementary school student can understand it. Buying low and selling high is a given. Yet there is a group of people who make money in the exact opposite way. They specialize in waiting for the market to go down to scoop up money, and sometimes the profits they rake in are even more staggering than those who go long. That is short selling. Hearing this term for the first time, you might find it a bit unorthodox. The market drops, others lose, yet they profit. Are they really betting on a collapse? What is even more baffling is that short sellers are usually not gamblers, but fund managers, analysts, and institutional investors. They even dedicate themselves to writing hundreds of pages of research reports just to prove why something should drop in price. They are not gambling at all. They are making well-founded judgments. Before the 2008 financial crisis, a group of people bet that the U.S. housing market would crash. The whole world at that time called them crazy. Banks, the media, and credit rating agencies uniformly mocked them. As a result, they walked away with billions of dollars. Among them was Michael Burry, a fund manager who single-handedly managed hundreds of millions of dollars in short positions. While everyone else was intoxicated by the illusion of getting rich from real estate, he persistently endured tremendous pressure and skepticism from his own investors for 2 grueling years to bring home a massive profit. This historic event was later adapted by Hollywood into the famous movie The Big Short. So, what kind of logical system is short selling after all? How does it operate? Where do the lethal risks hide, and why does the market tolerate its existence? The starting point of short selling is an action completely contrary to normal instinct. Selling something you don't even own. It sounds like a scam, but in reality, this is a trading mechanism that operates within an extremely strict legal framework. Specifically, how does this system work? Suppose you predict that a certain company's stock will definitely fall. The current price is $100. You don't hold any of the stock, but you can go to a brokerage firm or find other shareholders to borrow it in exchange for paying a certain borrowing fee. Once borrowed, you immediately sell it straight to the market to collect $100 in cash. This action is called opening a short position, meaning you borrow first and sell later. Next, you simply wait. If your judgment is correct and the stock price plummets to just $60, you use the money you initially collected to buy back the exact same amount of shares on the market at the dirt cheap price of $60 and then return them to the lender. The $40 difference after deducting costs like borrowing interest and transaction fees is your pocketed profit. The technical term for this maneuver is short selling. The entire logic chain boils down to borrowing to sell, waiting for the price to drop to buy back and repay the debt, and pocketing the difference. But the most terrifying and thrilling part lies in its risk structure. Those who go long always have a capped level of loss. Worst case scenario, they lose their entire initial capital because the stock price can only fall to zero, not into the negatives. However, for short sellers, theoretically, their potential loss is infinite. If you short at $100, but the price doesn't drop and instead skyrockets to $500, you are still forced to bite the bullet and buy it back at $500 to repay the debt, which means you suffer a loss of $400. The higher the price goes, the more disastrously the short seller bleeds. And since a rising asset has no ceiling, the potential loss has absolutely no floor. This is the core barrier that creates the brutality of this game, an asymmetrical risk where profits are capped but losses are boundless. The maximum profit in short selling is only 100% when the asset's value hits zero, but the door to destruction is always wide open. Because of this deadly structure, the players who dare to risk shorting the market must possess sharp analytical minds with extreme confidence, paired with ironclad risk management discipline. But just understanding the mechanism is not enough. We must ask why short sellers have the guts to bet against the tide while the rest of the world is cheering in euphoria. They are absolutely not blind gamblers speculating on a whim. Most of the time, they do the incredibly tedious and stressful job of looking for cracks. From financial statements, business models, and industry macroeconomic data to the shady actions of management, they peel back layers of information to find a massive gap between the price the market is hyping up and the decaying intrinsic value within. When that gap is large enough and the price is excessively inflated, they cast their nets by taking short positions. Carson Block, the founder of the notorious short-selling firm Muddy Waters Research, is a prime example. His team once infiltrated the Chinese market, conducting on-the-ground investigations targeting a slew of companies listed in the U.S. They didn't just sit in air-conditioned offices reading reports. They sent people to stake out right at the factory gates, counting every truck going in and out to calculate actual capacity and cross-checking every single tax invoice. In doing so, they uncovered the truth that many companies were blatantly falsifying their financial data. The most iconic case was exposing the Luckin Coffee chain in 2020. Based on tens of thousands of hours of store surveillance footage and tens of thousands of receipts, they proved that the company's revenue was artificially inflated. The moment their dossier was released, the stock price evaporated by more than 80%, and their short positions brought in massive profits. The ultimate weapon of this tactic is information asymmetry. Speaking of the power of holding secrets ahead of their time, if you want to explore deeper into how the savviest players are quietly getting rich off these very loopholes, click right away on the suggested video card Gray Area Secrets, the rule of making money from information asymmetry appearing in the top right corner of your screen. Returning to the short selling game, the market price always reflects the average perspective of the crowd, and the short seller's mission is to dig up shocking truths that the masses haven't seen or are deliberately covering up. Look back at the collapse of the energy empire Enron in 2001. Before it imploded, Enron was continuously named America's most innovative company for many years. Its stock price was sky high, and Wall Street analysts showered it with endless praise. But a few sharp-eyed short sellers caught the scent of death emanating from financial statements tangled with shady insider transactions and massive debts hidden off the balance sheet. When Enron collapsed due to fraud, those short sellers left behind a classic lesson for the financial textbooks. The decision to short is usually based on three main pillars: analyzing the financial model, investigating the actual supply chain, and assessing the industry's downward trends. All three of these paths require profound professional accumulation, consume an enormous amount of time, and leave absolutely no room for impulsive decisions. But there is a cruel dark side to this game. Short sellers may have uncovered the truth, but they still have to bet on when the crowd out there will finally wake up. Being right but at the wrong time still leads to burning through your pockets and being forced to liquidate your position in bitterness. The GameStop event in early 2021 is a bloody example of this risk. Massive hedge funds like Melvin Capital analyzed very accurately that GameStop's traditional physical game retail model was dying and its stock was vastly overpriced. They opened massive short positions, but they didn't anticipate the frenzied power of a mob of retail investors on the Reddit forum. This crowd banded together, buying relentlessly and driving GameStop's stock price from $20 to a peak of over $400. This absurdity forced short-selling funds into a catastrophe. They had to cut their losses, blowing away billions of dollars in just a few days, even though their fundamental analysis wasn't wrong. This proves that short selling is not merely a mathematical problem of asset valuation, but a life-or-death battle with the rhythm and insane psychology of the market. Sometimes this battle pushes short sellers to their absolute limits, forcing them to bet their entire financial lifelines on a single question: when will the bubble finally burst? Many people, when mentioning short selling, carry the prejudice that these are a flock of vultures intent on trampling market prices down to make money off the blood and sweat of others. But that instinct to place blame inadvertently dismisses the extremely crucial ecological role of the short-selling faction within the economic structure. Try to imagine what a stock market without a short-selling mechanism would look like. In such a place, prices would have only one way to go: up, completely devoid of critical voices to rein in absurdly inflated assets. Bubbles would just keep inflating to the max until the day they detonate, and the devastating consequences would crash down on everyone's heads. Short sellers are that brave minority voice willing to stand up in the middle of a high society banquet to shout that this price is garbage. During the 2000 dot-com bubble, a slew of tech companies couldn't generate a single dime of revenue, yet their market capitalizations still soared into the stratosphere. The entire market was drowning in a frenzy, while only the short sellers were continuously sounding the alarms. Even though they were made a laughingstock when the market peaked, once the bubble shattered, history recognized their merit. Academia has also proven the value of this mechanism using concrete data. A 2004 study by Harvard Business School pointed out that in markets where short selling operates freely, stock prices absorb negative information much faster compared to places that ban it. The swift reaction of prices to bad news means the time capital is buried in rotting companies is shortened, minimizing the heavy toll paid for the misallocation of resources. In some markets where the short-selling mechanism is heavily restricted for a long time, we easily observe a distorted phenomenon. When there is good news, prices immediately skyrocket. But when bad news breaks, the decline is incredibly sluggish and significantly delayed, severely degrading the market's efficiency. However, we must also fairly acknowledge that short selling is not an entirely pristine picture. There have been fierce debates about professional ethics when certain short-selling institutions are accused of intentionally issuing misleading reports coinciding with the moment they open a position, deliberately manufacturing artificial panic to line their pockets. The fragile boundary between discovering the truth and then shorting versus shorting first and then spreading malicious rumors is a problem that regulatory bodies in many countries are still struggling to control. Nevertheless, we cannot let the corruption of a few greedy individuals negate the core value of a mechanism that helps make the market more transparent. Returning to the most fatal risk of short selling, the essence of the cash flow pouring into a short seller's pocket stems from a gap in perception. You see through what others are blind to, or you remain sober while others are going mad, and when the truth is exposed, the margin reward will be yours. But behind that is a cold, cruel reality. At any given moment, the market price is always a mirror reflecting the average level of awareness of all participants. To win, short sellers must not only be exceptionally smarter than that average level, but also possess an extraordinary tolerance to survive until the day the market finally admits its mistake. This is a process that drains both cognitive resources and psychological endurance. The great economist John Maynard Keynes once left behind a classic quote that continually haunts the financial world: "The market can remain irrational longer than you can remain solvent." This curse perfectly sums up the tragedy of the short seller. You are completely right fundamentally, but throughout that time you are right. The market is still driven by bottomless greed. The price keeps soaring, your account keeps bleeding, and margin calls relentlessly scream your name. Short selling is, in essence, an endurance marathon between sharp perception and the depth of one's pockets. That is why professional short-selling funds usually maintain a size that isn't too bloated, but in return, the depth of their research is terrifyingly profound. They cannot survive if they only go with the flow. They are forced to build an independent system of critical thinking, completely isolated from the consensus of the crowd. Conversely, small retail investors jumping onto the short-selling path usually do not rely on analytical capability, but are merely betting based on emotion. Seeing a stock soaring too hot, through a subjective hunch, they deem it too expensive and blindly short it. This impulsive action is essentially no different from throwing money onto a roulette table in a casino. In-depth short-selling research requires knowledge of supply chain operations, the capacity to deconstruct financial statements, the skill to dissect legal documents, and even the art of on-the-ground intelligence investigation. Short sellers are willing to trade sweat, money, and brainpower because they know that pricing errors in the market can last a very long time, long enough for them to painstakingly set their traps and wait for the prey to spring them. In my own process of building a digital content brand and observing the relentless fluctuations of media trends, I have realized a profound lesson from the philosophy of short sellers. We are constantly surrounded by hyped-up trends and empty content that is praised to the heavens thanks to the bandwagon effect. If we only look at the surface, everyone thinks it's the absolute truth. But when you take the time to calm down and dig beneath that flashy exterior, you will find that many things are just phantom values, bubbles waiting to burst. The ability to keep a cool head, to go against the crowd, to short our own blind excitement, and to focus on true core values is the key to sustainable survival, whether in financial investing or daily content creation. The short-selling mechanism has handed us a great message. Any given price or trend present in the market is not the absolute truth. It is simply the average of the perceptions existing at that specific moment. When the current of perception shifts, prices are bound to shift with it. Short sellers are warriors betting their lives on that reallocation of awareness. They could be geniuses, or they could be folks who go broke right before dawn. They might have struck a fatal flaw, or they might just have jumped the gun months too early. Whatever the outcome, their presence has created a vital push, forcing the market to have a mechanism that punishes excessive arrogance and rewards those brave enough to seek the truth. That is the prerequisite for maintaining a healthy and uncorrupted pricing system. Looking further, short selling reflects a core philosophical issue about human consensus. In any era, in any field, there are always default truths worshipped by the majority. That real estate never goes down in price, that this tech stock is immortal, that business model is flawlessly perfect. These blind beliefs often persist incredibly stubbornly before the first cracks appear. Short sellers are those rare individuals who dare to put their hard-earned cash on the line to confront those prejudices head-on. They aren't always invincible, but their voices constantly force the crowd to bravely face the harsh truths being covered up. You don't necessarily have to become a seasoned short seller, but understanding its operational logic will equip you with a fiercely sharp lens through which to view the world. Every price on the market will forever just be a temporary consensus, never an eternal truth. The things that everyone considers self-evident are often the breeding grounds for the most dangerous cognitive blind spots. The next time you stand before a seemingly perfect get-rich-quick opportunity or see an asset skyrocketing and driving everyone around you crazy, take a breath, stop for a beat, and ask yourself, Is the sky-high price I am seeing due to it actually possessing immense intrinsic value, or simply because the number of fanatics temporarily outnumbers the skeptics? If you had to choose between buying to wait for something to increase in price and short selling to wait for a collapse, which philosophy do you feel better reflects your personality and character? Leave your thoughts in the comments section so we can dissect this issue together. Thank you for staying with me throughout the video. If you find that this perspective has brought you fresh and profound insights, please hit the subscribe button to empower Murky Fact on the journey of uncovering the truths behind socioeconomic phenomena. Goodbye, and see you all again in the next fascinating topics.